Okay, introduction to investments, some key points and ideas, and I'm not going to cover this whole PowerPoint in one section, but I will split it up into a few videos. The terms for this section are listed here. They will show up on the slide, so I'm not going to read them off. I just want to go through kind of the fundamentals of investing. This is a five-stage process. We don't always get to stage 5. Most of us get to stage 4. Stage 1 is when we have a put and take account. This is like a savings account, checking account, where you have enough money to survive for 3 to 6 months if you were to lose a job, so on and so forth. Stage 2 is when we begin investing. We're usually very conservative, low risk. These are probably CDs, savings bonds, so on and so forth. Stage 3 is a very systematic approach. This is when we start talking to other people. We might be making some investments. These are probably your job doing the investing for you. In the situation, if you're a state employee in Iowa, it's the IPERS program. Could be a 401k as well. Stage 4 is strategic investing. This is when you meet with an advisor. You very carefully plan and manage a portfolio to grow over the next 5 to 10 years. And then stage 5, which most of us don't get to, but some people do, is speculative investing. This is when we take bigger risks. We can make a lot of money, we lose a lot of money. This would be the examples of people that invested money in Apple, Microsoft, companies like that. Reasons to invest. Number one, if your portfolio grows more than 4% a year, which most do, you are beating inflation. As I said in class, inflation generally is around 2 to 3%. The rule of 72, 6% interest on a loan or on an investment. It's going to take 12 years for your money to double. So on and so forth. Reasons to invest: increase your wealth, increase other savings accounts. Obviously this is going to be better than investing in a bank, for example, a bank account, I should say. It's challenging. You're trying to pick winners. You're trying to take your time, and you have to have some patience with it. Risk and return. Risk is that a chance that the investment will decrease in value. Many people are risk averse. That means they're afraid to take any risk. And then the key is to diversify. We want less risk, which is short term, versus long term, which there is some more risk in that. We had high inflation in the 1970s. There is political risk, not so much in our country, but in other countries. The market risk. Market is fluctuating, which has been going on for quite some time. Then there's things outside of our control, outside of the market, that can happen. Weather related, could be economic things, could be wars. And then there's always company risk. Do they have money to survive? Criteria of selection: degree of safety, degree of liquidity, expected dividends or interest, expected growth in value, reasonable purchase price and fees, tax benefits. All of those factor in. Now, not every single one is going to be a checklist where you mark that off, but it depends what you're looking for. It depends kind of what it is that you are trying to invest in. Investment strategies. Okay, obviously an investor would go, or a broker would go through this with you, but you got to have goals. They have to know what you're looking for. You usually go through the process slowly. You want to make sure you're keeping records. You're getting advice as things progress or regress, that is. And then you got to know your limits. You don't want to get stretched out so thin that you can't invest anymore either. Sources of information. Most of us probably are going to go online, or we're going to talk to our advisor. Our options, okay, low risk, corporate municipal bonds. Again, these are IOUs. Other options that are low risk: U.S. savings bonds. Again, we're loaning money to the U.S. government, hopeful that it's going to be paid back. Medium risk return: this would be a stock, mutual fund, All of those we've talked about in detail. Medium, again, annuities. This would be your life insurance. Real estate, again, there's risk involved with that. And then the high risk would be buying futures. This could be corn, soybeans, could be gold, silver, things like that. Options fit in there as well. Penny stocks, again, cheap stocks that we can buy at a low price. Hopefully they go up. And then collectibles.